So we will begin the presentation and we'll just let people log in as we carry on here. So why don't we get started here without further ado. This evening's webinar, the new mortgage rule changes and how will they affect me? So as I mentioned, my name is Marco Gello and I'll be hosting, this is what we're calling the 10-minute webinar. And thanks so much for logging in. This is something new that we thought we'd give a try and see how well it's received. And judging from the attendance on this webinar this evening, we'll definitely be continuing in the future. So we have just close to 25 people who have joined us this evening. So thanks for all joining us tonight. I promise you it'll be worth your time. So we really felt it was important to make a strong effort to reach out to our existing client and referral base to keep everyone informed of the current lending environment and the direction it's headed. So that particular direction we're referring to is that much like the one we're currently on and have been on since 2008, which is totally unpredictable. So I'll give it a formal description this evening, and we'll call it dynamic. And I like to refer to it as dynamic because as mortgage brokers, we've clearly had to accept and adapt to the term roll with the punches. So the webinar this evening will not be focused on where to shift the blame for the current state of lending. I mean, all the news broadcasts do a great job of that. Instead, we will address what we believe are the challenges and prepare you with the strategies and tips on how to overcome them. And if anyone does have a question or comment during the presentation, please type it into your GoToWebinar sidebar there, and I will try to address all of them at the end of the webinar. If I don't get to them, please email either myself or the Mortgage Center associate who provided this link for you, and we'll definitely respond to you with the answer within 24 hours. So as I outlined in the introduction, September 15th, 2008 marked the beginning of what many mortgage industry insiders will for a very long time remember as a time when the industry quite literally was forced to reinvent itself. And at the time, the mortgage and the real estate industry was riding on quite a high. If you were in that market at the time, you'd remember we're talking about products you may recall 40-year amortizations, zero down mortgages, zero down payment mortgages, low interest rates, waived appraisal valuations, and of course the now infamous no income qualifier mortgage, or how our friends in the USA term them, ninja mortgages. So that acronym, if you're not familiar, stands for no income, no job, and assets. Pretty funny, but true to the bone. Obviously, a lot has changed since that day, and today I'd like to provide you with some perspective and insight. As you can see from the screen, there's 4 particular dates since September 2008 that these changes have been introduced to Canadians. Rather than keying in on each change, I've narrowed it down to the main policy changes of what we'll look at here. So here are the key factors right now responsible for the market in its current state today across the country. So the first one, the 25-year amortization, clearly we've seen the greatest impact on the market as a result of this rule change. Qualifying rates we're going to talk about. So this is commonly something not discussed in the general public regarding qualifying rates, but it's kind of a behind the scenes analysis on how mortgage loans are qualified, and it'll shed some light on why the most common rate selection with all clients today is a 5-year fixed. Appraisals versus auto evaluations, where we're seeing more appraisals, so we'll talk about that. And the reasonability factor for self-employed applicants. If you're self-employed or even 100% commission, drawn income from 100% commission, you'll really understand what I'm getting at here. But we'll chat more about that. And of course, the refinance limit, the reduction, it's been reduced to 80% loan to value. Okay, and by the way, before we move any further, these particular rule changes that I'll be presenting this evening pertain only to high ratio mortgages. So of course, as it says on the screen there, this is for mortgages less than 20% down payment. on purchases and up to 80% loan to value on refinances. Here are the three main insurers in the country. Many of you may be familiar with one of them, and that's CMHC. They currently, I would say, their portfolio consists of a great majority of all the homes in Canada. So they seem to be the go-to insurer, mainly for the reason is because they are backed by the government of Canada. The other two alternatives there, Canada Guarantee and Genworth Financial, are private insurers. So when it comes to investors forking out money for mortgage purposes, they tend to migrate towards CMHC insured mortgages because they provide the greatest guarantee and security for the money. Okay, so let's look at the first point here, 25-year amortization. And the best way I can exemplify this is with an example here. So let's consider a $80,000 combined income and no debt. And here's where we are coming from the heyday back in 2006, riding all the way up until late 2008 and early 2009, where on a 40-year amortization, that couple or individual would be able to qualify for a $700,000 mortgage, 40-year amortization. Now, fast forward today, over a period of 3 to 4.5 years, we've brought that amortization down to 25 years. The government has that. And as a result, that same $80,000 combined income will now qualify for a home of $520,000. So you can see, without all the fine print and all the sophisticated articles in the newspaper as to where real estate has gone in the country, just one of these rule changes and the impact it has had on MLS listing prices across the country. And in some pockets in the country, greater than in others. So $180,000 purchasing power difference just on the amortization rule change. So very, very interesting, and of course affecting many Canadians across the country. Number two, if we stay on the same example, $80,000 combined income and no debt. Another thing that's come into play, what we find our clients are understanding more of, is where qualifying rates come into play. So we look at that previous example of a 40-year and a 25-year AM. That was qualified based on a 5-year fixed at 3.09%. Okay. Now, what if you wanted a variable rate mortgage? Okay. So here we are in today's rule book. We would have to qualify it under a 25-year amortization, but because we want a term less than 5 years, we would have to use the 5-year benchmark, which is 5.24%. So right now, not only has the qualifying or the purchasing power been pinched by the amortization, but enter the qualifying rate. As you can see, you qualify for $95,000 less just by choosing to go with a variable or a home equity line of credit. So oftentimes when we're doing pre-approvals, people would like to know the absolute maximum that they qualify for. And many times this pre-approval will be presented with a 5-year fixed qualifying rate. All right, so just something to be aware of if you've ever wondered why you couldn't qualify for a variable rate mortgage, simply because of the qualifying rate. Appraisals and auto evaluations. So appraisals are required for mortgage applications that are not high ratio. Okay, so regardless of whether you're purchasing or financing, what your net worth is like or how good your credit is, if you put if you put more than 20% down payment, this will automatically generate a request for an appraisal. And that is for one simple reason, and because the mortgage would not be insured. As soon as you put less than 20% down payment, usually the appraisals are waived. But what we're seeing more of, and they're waived because the mortgage is insured, so it poses less risk for the lender. In the event of a default, the lender gets paid out by the insurer, CMHC. So typically appraisals are not required for deals that are insured, greater than 80% loan to value. But lately, they are requesting them on all types of applications. So expect these kinds of holdups when you're purchasing a home. And if you put an offer in on a home and you're going really tight on 3 to 5 days financing conditions, heads up. If an appraisal comes back from CMHC suddenly, you may need to ask for an extension on that deal. Another common misconception out there is property tax assessments. So very often we'll do a refinance or a purchase application for a client, and they'll fax or email us their property tax assessment, which happens to be a favorable value depending where you live. But unfortunately, these have nothing to do with appraised values with the lenders. Property tax assessments are calculated for different reasons by local municipalities, whereas the appraisals capture the market, I believe, in the last 3 to 6 months. So the house down the street that sold $50,000 under list price or under market value, unfortunately, affects the whole neighborhood. Whereas a property tax assessment, you'll get consistent assessments all across the neighborhood. Expect the unexpected. So extend your conditions date due to a late appraisal request from an insurer. And your home value doesn't quite equate to what you estimated its value at. So again, this is real estate, and more than ever, especially in down markets, expect the unexpected, and especially when you're purchasing and there are financing conditions involved. So time is of the essence, and as soon as you put an offer down on the house, I encourage you, whether you're dealing with your bank or with a mortgage broker, get those documents to them the instant that you submitted the offer. Even if it's a Sunday night, start faxing it over to their office, and because as I said, time is of the essence. So really, what's forcing the appraisal issue and the elimination of auto evaluations is very simple. It's supply and demand. So as we get into market segments across the country, like I said, different pockets and different regions have different supply and demand ratios. The fourth point here, reasonability factor for self-employed applicants. Here is basically where we've come from. So in the past 6 to 7 years, self-employed individuals were able to enjoy a privilege of declaring low incomes. And of course, everyone who owns a business will tell you that they are in business to win the tax game. So the Revenue Canada, the Government of Canada understood this, and they accepted the low declared income because they felt that, okay, obviously you were keeping the money in the business, so you wouldn't have to draw from it, and you're enjoying other tax strategies of drawing that income out. So they gave you the benefit of the doubt, and they allowed you to state your income. As long as you had no taxes owing on your notice of assessment, you were able to state your income. But fast forward to today, in an underperforming economy, banks began to view it another way. So today, they look at low declared income, and they're not seeing eye to eye with the self-employed or the business owner. They clearly see it as an underperforming business. And right now, they're asking for extraneous conditions, so either additional years of notice of assessments, or they're actually requesting bank account statements or financials to actually see what amount of money is in the company. So stated income products are still offered, but it's under what they call a reasonability factor. So for example, if you're a self-contracted engineer working downtown Calgary, they will have their resource list of all the occupations, and they'll have a generic income that they believe an electrical engineer would earn being self-employed. So if we state your income as $180,000 a year, they may have their limit at about 120. Okay, so we get to a lot of disputes with the lenders on this, and oftentimes we're able to counter with more documentation from the client. So heads up on that. Lots has changed as far as qualifying for self-employed. Flexible stated income or equity lending programs are still available. However, they are with, they used to call this type of lending subprime. That's not the preferred term these days. It's alternative lending. So there are mortgages out there that have less restrictions and less requirements. Obviously, you compromise your interest rate anywhere from 1% higher to 3 to 4% higher. So those options are